What if the money in your pocket was never designed to make you free? What if it was part of a system older, deeper, and far more intentional than anyone ever told you? We live in a world where every country is in debt. Every dollar, euro, yen, and pound exists because someone owes it. But that raises the question nobody dares to ask. Who was the first creditor? Where did this system begin? The one that decides who prospers, who suffers, and who controls the future of entire nations. Today, we're going back, far back, to uncover the forgotten origins of the financial system that quietly controls humanity. A system built not on gold, not on labor, but on debt, trust, and illusion. To understand how money became controlled, we have to begin where most history books end, with the merchants of the early Renaissance. In the 14th century, the great Italian city-states like Florence and Venice were the trading hubs of the world. But gold was heavy, dangerous to move, and easy to steal. So merchants began using promissory notes, pieces of paper representing stored value. These notes were revolutionary. For the first time, wealth could move faster than people. But it also meant that whoever controlled the issuance of paper credit controlled the flow of trade itself. Enter the Medici family, Florence's most powerful bankers. They didn't just lend money, they created it through accounting entries. By lending out more credit than they actually possessed in gold, they effectively invented early fractional banking. This idea, lending what you don't have, would become the cornerstone of modern finance. It turned invisible promises into tangible power, and it worked so well that it spread like wildfire through Europe. But behind this innovation lay a dangerous truth. Once money could be created from nothing, someone had to decide who got it and who didn't. By the 17th century, the game changed again. Wars were expensive. Kings and queens were addicted to borrowing, so they struck deals with bankers, private financiers, who could fund empires in exchange for something far greater than gold: influence. In 1694, England created the Bank of England, the first true central bank. It was a public-private partnership, meaning it was partly owned by private shareholders but acted in the name of the crown. The bank would lend money to the government, with interest, backed by taxes on the people. The state got instant credit, the bankers got guaranteed repayment, and the people got debt. It was the perfect loop. Every pound in circulation existed because the government owed it to the bank. Money became debt, and debt became money. From then on, wars, revolutions, and industrialization were all financed through this system. Every nation that wanted power had to play the same game: borrow, tax, and repeat. And the more they borrowed, the more powerful the central banks became. By the 19th century, Europe's monarchs had lost control of their own currencies. But the bankers, the Rothschilds, the Barings, the Morgans, they controlled the very heartbeat of global finance. They were no longer just merchants of money, they were architects of empires. Then came the 20th century, when the system hit both its peak and its breaking point. In 1913, the United States quietly passed the Federal Reserve Act. Behind closed doors on Jekyll Island, a small group of bankers and politicians designed a system that mirrored the Bank of England but on a global scale. The Federal Reserve would issue the nation's money supply, not the government itself, and every dollar printed would be borne as debt owed back to the central bank. The same pattern repeated worldwide. Countries created independent central banks, disconnected from direct political control, yet intertwined with private finance. The illusion of independence hid the reality of ownership. And once again, the loop was sealed. Governments borrow. Central banks create money, and citizens pay the interest through taxes. But World War I, World War II, and the Great Depression exposed the system's instability. Gold-backed currencies collapsed. Nations defaulted. And yet, every crisis made the same system stronger. Because when economies crashed, governments didn't question the bankers. They turned to them for rescue. Debt became salvation. And the more the world suffered, the more the system expanded. In 1971, the last tether to reality was cut. President Richard Nixon announced the end of the gold standard, severing the US dollar from any physical backing. From that day on, money became pure faith. A number on a screen, a belief in government, and a promise to pay that could never truly be paid. But the world didn't collapse. It exploded. Credit markets boomed. Governments printed more, borrowed more, and built entire economies on promises. The system had evolved from debt-based to belief-based, and it worked, as long as people believed. However, the underlying equation didn't change. Every dollar still represented a debt, and for one side of the ledger to grow, the other must owe more. Today, global debt has surpassed $350 trillion, more than 4 times the world's total GDP. That means humanity owes more money than it has ever created in real value. But to whom? The answer lies in the layers of financial instruments that circulate between central banks, private institutions, and shadow markets. In this system, debt itself has become the ultimate product, and those who control it control everything. Modern central banks like the Federal Reserve now create trillions out of thin air to stabilize markets. They call it quantitative easing, a sanitized term for digital money printing. But each round of stabilization only deepens dependency. The rich get richer through asset inflation. The middle class watches their purchasing power vanish. And governments continue to promise growth that can only be bought with future debt. It's the same pattern repeating since the Medici ledgers of Florence. Money creation, temporary prosperity, concentration of power, inevitable collapse, and a controlled reset. And every time, the system emerges stronger, more centralized, and more detached from reality. Look at the world today. Digital currencies are replacing cash. Central bank digital currencies, or CBDCs, are on the horizon. They promise convenience, security, and control. But behind the marketing lies the next stage of evolution. Money that can be programmed, money that can expire, be restricted, or tracked at every step. If the first financial revolution turned gold into paper, and the second turned paper into code, the third will turn code into control. And once that happens, financial freedom becomes a relic of the past. So, what are the 3 key takeaways? First, the financial system we live under wasn't built overnight. It was engineered over centuries, evolving from merchant notes to digital control mechanisms. Second, every crisis, from wars to recessions, hasn't broken the system. It has refined it, making those who create money ever more powerful. And third, debt isn't a flaw in the system. Debt is the system. It is the engine that keeps it running, and the chain that keeps it from ever truly changing. So what happens next? If history is a guide, the next solution will come disguised as innovation, a digital currency, a reset, a new promise to fix what was never meant to be fixed. But awareness is power. Understanding how we got here is the first step to imagining something different. Because once you see the illusion, you can no longer unsee it. If you found this deep dive valuable, share it. The story of money is the story of control, and only by learning its past can we reclaim its future. Subscribe for more untold histories of money, power, and the hidden forces shaping our world.